The Retirement Cafe podcast, episode 35, What Makes a Successful Investment Strategy in Retirement, with David Jones of Dimensional Fund Advisors.
Retired or thinking about retirement? You've come to the right place. Welcome to the Retirement Cafe podcast. In each episode, we bring you an important conversation with insight, tips and knowledge, all designed to help you live a fulfilling and successful life in retirement. Here's your host, Chartered Financial Planner and accredited later life advisor, Justin King.
Hello and welcome to the latest episode of the Retirement Cafe podcast. This week, I'm delighted to share the second part of my conversation with David Jones of Dimensional Fund Advisors. And if you missed the first part of our conversation, you can head to the retirementcafe.co.uk and search for episode 34, or on your podcaster player of choice. It's titled Academically Proven Approach to Investing. I really enjoyed where our conversation was headed, and David has just turned 60, so I asked him what the future holds for him. But before getting on to David's personal life, I started by asking, how do you, as a fund manager, implement, and how does a retiree implement, a successful investment strategy? So here's my chat with David Jones of Dimensional Fund Advisors.
If you think about, what does it take to have a successful investing experience? I mean, that's essentially what people want to have. And I think it starts actually with clarifying what the goals are. What are your outcomes? Because then that can tell you a lot about how you should invest your money. And so if you get your goals clarified and you have an understanding of the rate of return that you need in order to deliver on that, and for that rate of return to be realistic. If you sit down with somebody and say, well, we've done your financial plan and we've calculated that you're going to need a 20% return on your investments in order to achieve your goals, there you go. You have to go back and really look at your expectations as to what's realistic, and educate them as to what are the rates of return that you can expect on whether it's global equities or global bonds, whatever's going to be in the asset allocation. So that's the starting point. And then it's really understanding, okay, for the asset allocation, what is the characteristics of the different assets that you're going to be putting into the plan? So equity is likely to be the driver of the returns in the plan, but not everybody has the capacity or the risk tolerance to take 100% equity portfolio, and that wouldn't necessarily be appropriate. So you're going to design the portfolio to deliver the long-term objectives of the portfolio, which is likely to be driven by more equity investment, with the shorter-term needs for liquidity or volatility dampening that allows them to stay in their seat when things get a bit rough, and the seas sort of coming over the bows of the boat. So I think it's important to have that understanding, and then if you get the goals right, so you know you're benchmarking to your own goals, you understand the nature of the investments that you're putting into your portfolio, then the key is to stay disciplined. Actually staying on track, understanding that if markets are volatile, that's what you expected ahead of time. Yeah. So stay in your seat, and then tune out the noise. Because we know that there are millions of potential sources of information that people have about their investing and their future lives, whether that's from the mainstream media or social media or the brother-in-law or the notorious bloke in the pub who has some view on how people should invest. It's actually, can you tune that out to say, no, I have my plan, I have my portfolio, it's designed to do this, I've benchmarked it against my own needs, not against other people's needs. And generally speaking, then those needs are best served by a really good advisor, because they're going to take all that heavy lifting away. They're going to help you clarify your goals, they're going to put in place an appropriate asset allocation, they're going to help you stay disciplined when everything around them is screaming, do something different. Don't just stand there, do something. But actually, it should be the other way around. Don't just do something, stand there, and tune out all this it's other noise. Absolutely. So I think then to come back to the original part of your question, which was around, well, how should a fund manager implement, how should we implement, is we want to make sure that what we're doing in putting financial science to work in portfolios is that we be really careful that these are going to behave in the way that you expected them to behave. So are we doing something very different to what we said that we would do? No, you want to see us delivering the outcomes in a very consistent way, that we're managing people's money appropriately. Now, some of these things are very simple to say. Of course, we're going out into markets and we're buying stocks based on the criteria that we need for each of these different portfolios. Under the surface, a huge amount of work goes on to make sure that we're identifying the right stocks to buy. How we build the portfolios. On any given day, there's going to be all sorts of different corporate actions, all sorts of different things will happen in the market. Something new will happen that will move market prices today. There's going to be requirements for liquidity, for all of these things. And so if you could see the amount of millions of pieces of data that we are handling on a daily basis in order for us to be managing portfolios that in some cases will have upwards of 12,000 individual securities in them, you start to realize that it becomes actually very complex. And so at Dimensional, we invest very heavily in the technology that we need in order to be able to manage highly diversified portfolios at a reasonable cost. Because if you didn't control costs, that would have a huge impact on people's outcomes. So we're constantly managing trade-offs. We're constantly managing, trying to identify that systematically the securities with the higher expected returns, with the diversification that we need in the portfolio, with the prices that we're observing in the market on any given day. So this is, if you can imagine a 5-dimensional chess game, which you probably can't because we can't really imagine things beyond 3 dimensions. But that's essentially what's going on, this multi-dimensional, multi-layered approach to delivering returns. So I think it's helpful, to just see, well, what lenses are we actually applying to a market on any given day? And just to simplify it a little bit for the listeners, we're looking at things through a long-term lens, short-term lens, and a daily lens or an intraday lens. So big picture, yes, we're identifying securities based on market capitalization or value securities or securities with higher direct profitability. On a shorter term basis, we know that there are other effects that we can observe, for example, through securities lending or momentum, the tendency for stocks that are rising quickly in value to keep going in that direction for a short period of time, or securities that are plummeting in value to keep plummeting for a short period of time. So you want to make sure that when you're managing portfolios that you're taking advantage of that information that is being presented to you by the market. But then on a daily basis and actually intraday, so things that are happening during the trading day, that we're setting up our systems and processes appropriately to make sure that we can take advantage of those movements that are happening on a daily basis in the market. So if we were to walk about 50 yards down the corridor to where the traders are working right now, you'd be able to see actually what's going on as they're managing thousands of stocks in portfolios. It's, technology is doing a lot of the heavy lifting, but they're sort of keeping an eye on everything that is happening, because we want to make sure that we're trading as efficiently as we can on a daily basis, because we don't want to give up costs, because that has an impact on clients' returns.
Clients' returns, absolutely.
Yeah.
So one thing that is quite unique about Dimensional is that you're not open to the I don't think you are anyway, to the kind of the retail market. I mean, someone can't phone up Dimensional and buy one of your funds.
Correct.
You know, they can only access them through people like myself, etc. Tell me about that relationship. Why how's that come about?
Well, originally, when Dimensional started in 1981, with the idea, the first fund was a small company fund in the US. It was an institutional manager. So our clients were large institutions, and when you work with large institutions, you're dealing with professional investors, and they understand.
So that like be a university or a state?
Yeah, it could be a university endowment, it could be a large company's pension fund, and so they understand, you know, what we're trying to do, but they also understood that this was long-term buy and hold investments. And they appreciated what Dimensional was trying to do, which was something very different from other asset managers. And so, you know, it's that conversation that we're able to enter into with people so that they understand really what we're trying to do. And this engagement is not a sort of a very short-term transactional engagement. And so when back in the late 1980s, an advisor in the US, a guy called Dan Wheeler, wanted to start using Dimensional funds for his clients, who would be classified as retail clients, Dimensional was at first reticent, because they're saying, well, actually, we don't want this, in inverted commas, ill-disciplined kind of retail investor behavior, or the sort of swapping in and out.
Because they'll jump in, jump out, and that'll stuff up your investment philosophy.
I mean, well, it could hurt the returns of the fund. So,
it would be difficult. As a manager, you're running money. You're trying to run money for a long-term process, and then if you've got someone who wants to buy this week and sell next week, that causes a
it causes an issue. I mean, in a lot of. Let's say you're a portfolio manager, and you come into work one day and you've got lots of great ideas that you want to put to work, and there's been some wobble in the markets, and 20% of your investors have phoned up and want to redeem because there's been some wobble.
So suddenly you might have to sell all those buy-to-let portfolios that you'd bought. Not that you do, but in essence for the story. Yeah. But you've had to sell all those properties you bought the previous week, and no one would want to do that.
Exactly right. And so actually, you're forcing liquidity when liquidity is expensive. So for Dimensional, in working with initially this first financial advisor, and then recognizing that he was one of this burgeoning community of advisors who wanted to do something very different for their clients, work in a very different way, typically shifting away from that old sort of brokerage commission world into this financial planning, holistic provision of advice, typically on a fee basis. And Dimensional and this sort of growing movement of financial planners sort of came together in a very sort of happy alliance, and that was really the start of Dimensional's sort of second phase. After this initial phase where it was just an institutional manager, started developing these relationships with financial advisors, which has become the biggest part of our business globally. So I think for Dimensional, we have always sort of recognized that clients who are well advised generally will have a higher probability of a successful investing outcome than clients who are not advised or badly advised. Let's face it. And so we've always had this view of supporting the financial advisor community with, typically starting with education. We've invested a lot of resources in helping advisors really understand the work that we've done, and the academics that we're associated with that they've done in understanding how markets work and how you can systematically identify investments with higher expected returns and build these into portfolios that are going to have meaningful outcomes for clients. And so we've invested huge resources into that, and we think that we will continue to do so into the future.
How would how would someone who's listening to us who, maybe not got an advisor or hasn't got an advisor, how would they find an advisor who could access Dimensional?
If they contact Dimensional, so we would put them in touch with advisors in their local area who we know, and we don't endorse them.
Sure.
They have to do their own due diligence on those advisors, but we have a find an advisor process.
Right.
If people want to know more about Dimensional, they can go to dimensional.com and navigate to the blog section of our website, and see lots of interesting discussions about investment matters there. So there's lots of information available to them.
We'll put that in the show notes. And so just on a personal level, I know that, you turned 60 last week. So happy birthday.
I did. Well, thank you very much. Don't feel a day over 59.
And so, a lot of the people who are listening to this are actually approaching or in retirement. So tell me about what you picture your retirement to be like. I'm not committing you to a date, by the way. So
Well, I think the first thing to think about is, I've done quite a lot of thinking about this, and I'm quite attracted to this Japanese idea of it's called Kanreki. Kanreki is when you're 60 in Japan, the birthday is called Kanreki, and it essentially is the completion of one complete cycle of the zodiac. You've lived a complete cycle, and the next cycle starts. Essentially, it's an opportunity for rebirth, and I was very attracted to that idea. And when I compared it, so this idea of rebirth to retirement, and the operative verb in retire is withdraw, and I thought, actually, no, I'm not interested in a withdrawal. I'm much more interested in this idea of a rebirth. So I looked up. It was Dr. Martin Seligman, who's one of the professors who's done a lot of work on positive psychology. What was a definition of happiness? And it combined these three things: enjoyment, engagement, and meaning. So a life that combines enjoyment, engagement, and meaning kind of adds up to sort of a happier, more fulfilled life. So for me, retirement isn't about withdrawing. It's about exploring ways to have enjoyment, engagement, and meaning. One of the ways that you can do that, there's no requirement on me to stop doing what I'm doing, which is great because I love doing what I'm doing. And I think helping people have better outcomes in their investing lives is a way to have meaning in life. And engaging with people, whether it's colleagues here or it's advisors that we work with, is actually an incredibly fulfilling way to live a life. So then it brings us to the enjoyment part, and for me that's being as physically active as I can possibly be. So I still compete in rowing. I'm a very keen cyclist, and trying to stay as physically active as I can. And I think for a lot of people coming up to retirement now, I think our expectations are very different from maybe our parents' generation, which sort of is this slide into inactivity. And I think we think very differently now, that we think that if we can maintain physical fitness and look after our diet, look after our our bodies, that actually there's no reason why into our 80s or 90s we wouldn't just be as active as we possibly could be. So for me, it's doing all of those things to have an enjoyable life, not a life of withdrawal.
Absolutely, wise words. Thank you so much, David, for joining me today on the Retirement Cafe podcast. I mean, that's been absolutely fascinating. I think, I think a lot of people don't understand what fund managers do. They pass their money across to insurance companies, or, and it's a bit of a dark art. It's a bit of a, how do they choose which ones to choose? How do the advisors choose which funds to choose? It's complex. So to get some insight into that, Dimensional are just one fund manager out of hundreds available, but one that I've chosen to partner with, and I get also that you're passionate about, if you can deliver successful investment experiences to all these advisors who are investing their clients, who are trusting you with their clients' money, there's a huge amount of pride which comes from your comments there about the deliverable to the greater world that you're doing. So I admire you for that philosophy. So thank you so much for joining me today. I've really loved chatting to you.
Thank you very much.
I'll put some links into Dimensional website into the show notes. So if people want to find out more about David and the work that he does at Dimensional or about Dimensional and their philosophy, you can find out more. So bringing to an end, that's the Retirement Cafe podcast. I hope you've enjoyed the episode. If you want to ask me any questions or let me know what you think, you can contact me on jk@mfpwealthmanagement.co.uk or on Twitter at JustinKingCFB. Please tell your friends, leave a review so more people can like you can find us. So until next time, this is Justin King helping you feel more informed in your retirement.
Thank you for listening to the Retirement Cafe podcast with Justin King. To find out more, you can find us online at theretirementcafe.co.uk.